because energy is the biggest laggard in the S&P 500, dragging down the rest of the market today. But there's something very interesting happening with oil. Prices continue to fall, even as OPEC is smack dab in the middle of a production cut. That seems illogical. So let's figure it out with Kate Richards, CEO of Warwick Energy. We've got investments in more than 4,500 operating oil and gas wells. Kate, is there a scenario here where OPEC has kind of shot itself with a collective foot because they forced the U.S. shale producers to become so doggone efficient that we're just going to keep pumping more oil?
I think there's a real risk of that. And one of the things that we've been telling our investors throughout this year is that the biggest risk for crude this year is the prospect of a market share war, or at least showdown, between OPEC producers and the U.S. producers, because what OPEC has shown is that it clearly cannot stomach $40 to $50 oil, whereas the U.S. producers over the past 2 years have gotten more and more efficient. We've retooled our cost structure. We've become cheaper. We've become more efficient. And we can now make really good money in the core plays in the U.S. at $40 to $50 oil. And it's very unclear how OPEC is going to work with that and resolve those issues.
Well, we'll see if they can, Kate, because we heard at the CERAWeek conference in Houston last week, Iraq wants to go to 5 million by the second half of the year. It's almost like, you know, the other nations get around and go, well, if they're going to go 5 million, I'm not going to get screwed over. I'm going to go 2 million. And all of a sudden we have way too much oil. Is that what you think is going to happen? Are we going to have a continued supply glut in the second half of the year?
You know, it takes more time than people think for an oil well to come online. And this is one of the things that I think people were so confused about in 2015, because prices fell into the 20s in the first quarter and crude production didn't go down. And part of the reason is that it takes 6 to 8 months between a drilling decision and production coming online. And that's something the market continues not to understand. So Iraq saying it can go to 5,000 barrels a day, 5 million barrels a day, there's a huge amount of risk to that from a timing and from an infrastructure standpoint. Yeah. I think the biggest issue is you'll see huge dispersion in returns between the core haves and the core have-nots. So the U.S. has plays like the Permian and the Scoop and the Stack that make money between $40 and $50 oil. But there are parts of those plays that are the most core. And so the companies that have core acreage in those plays are the ones that will pay out. And, you know, the other thing about this, you know, trade down from $55 oil to $47 oil that we've seen over the past few days is that it's also driven by technical factors related to this hedge fund speculative net length that has been well reported. And one of my favorite crude market analysts at Aegis in Houston actually called it a clown car trade over the weekend. And that's
wow.
a source of instability for the market. And so partly what you're seeing is not oversupply or inventories growing or demand falling, you know, the fundamental things you would really be concerned about with crude. Part of it is just speculative net long, kind of hedge fund length in the market falling. And that's much healthier for the market overall. And
it
so
is
I think
healthier.
that's
Well,
kind of
hey,
the biggest thing.
well, hopefully nobody will blame it on Bill Ackman. Let's talk about, though, last question. You work amongst all these oil companies. You own stakes in 4,500 operating oil and gas wells. You literally live around a lot of oil executives in Oklahoma. What are they saying? Are they saying, you know, prices are down, but we're going to keep drilling, that rig counts are going to go up because we're just going to do it because we can make money at $40 a barrel?
You'll see that in the cores. So, you know, in the Scoop and the Stack, there's the big five like Marathon, Continental, Devon, Newfield, Cimarex. Those guys are going to make money between 40 and 50. They're ramping rig count this year. But there are other parts of plays like the Southern Midland Basin or the Bakken or parts of the Rockies that don't make money at $40 oil. They don't make money at $50 oil. And that's where you'll see rig count decline. That's where you'll see production is slower to actually rise. All of these companies kind of came out and raised CapEx and then raised production a little bit. You won't see all of that production come home to roost. And by the way, the thing that's most important to remember is that most of the production growth in the U.S. for the public companies is intended to occur in the latter part of the third quarter and in the fourth quarter of 2017. So there's a lot of risk to that actually happening. But also, if you look at the market overall, demand is up. So global demand is going to grow 1.2 to 1.4 million barrels this year. Inventories are correcting in terms of crude supply. And, you know, speculative net length getting out of the market makes things more stable. And so there's actually a lot of really positive things that we've seen in the market. And the other thing that's interesting is that we really obsess about the forward curve. And it's been like pretty flat between 42 and 50 or $52 and $55 oil for the past few weeks. But the forward curve is a terrible predictor of crude prices. And if you look over the past 10 years, the forward curve for the next 2 years versus what prices ultimately was has an R squared of 2%. So
we're going to end it, Kate. We got to end it. When you said R squared, and so you know I'm out because I'm not obsessed with the forward curve. I'm obsessed with the ice storm. But Kate Richards, awesome analysis as always, Kate. Thank you very much.